Welcome to today's webinar, compiled and produced by the team at biznews.com. All of our webinars are interactive. We encourage you to pose questions to our guests. The more challenging, the better. And the earlier you get the questions in, the better the chance of having them answered. The recording of this webinar will be available later today on the biznews.com channel on YouTube. Well, a very, very special webinar again today. Once more, we have our partners at OrbVest unveiling a new property opportunity, and it's a warm welcome to Martin Freeman, for joining us from New York. Martin.
Good morning, Alec. Thanks for having me on.
And Justin Clarke, who was recently at the BizNews conference. Justin, I hope you got quite a lot of opportunity to talk with our community members there. I know a lot of the guys who were at the conference are OrbVest investors and seem very happy by that, by the returns you guys have generated.
Yeah, Alec, it was really a fantastic conference. I hope that September is fully booked because I certainly would like to be there. I think, it really went.
Great stuff. Okay, Martin, you hearing me loud and clear? I was a little bit struggling with Justin to pick him up there.
Got you loud and clear.
Okay, well, let's start off with the presentation today because there's quite a lot of ground for us to get through. Justin, you're going to be starting off by explaining perhaps the introduction part, and then Martin will be telling us about the actual opportunity. So over to you, sir.
Yeah, Alec, I thought that, we spoke at the conference about the medical disruption, which we've never really covered before on these webinars. And I think it was very interesting, and we got a lot of reaction from it afterwards. So I thought it might be nice just to talk about some of these things that are affecting medical and the way that medical services are being delivered in the world. In fact, it's not just the USA, and I think it's particularly interesting to your audience. Almost we covered this in a complete webinar, perhaps on another day with our chairman. But if you go to the next slide, for example, and we take overall US expenditure on medical, on healthcare, and I think this is a very, very interesting and scary graph. People do ask us a lot about what was the effect of Obamacare on the demand on medical buildings? What has the effect of Trump been on healthcare expenditure? And this really shows it. 1960 until, that's the latest we got, 2019. You see that graph absolutely does not bend. And if we were to surmise the effect of COVID on medical expenditure, obviously we'd expect that black graph would pop up a little bit at the end. So, is this sustainable? I guess, the answer is no. It's already a very, very large proportion now, March. I think it's 16% of US GDP. So, it's running ahead of the orange line, which is GDP growth. You can see it there. And I think, the question is, what is healthcare going to look like in the future? So there are two first points, and I think let's go to the next slide and have a quick look at the inpatient versus outpatient trend. And I think if you consider, when you were last involved in a hospital experience. Now, take child, for example. If you were to have a cesarean, you would be in hospital for a week at least, and now you are 48 hours.
Justin, sorry, your internet is breaking up really, really badly to the degree that we can only hear every second word. I'm not sure, Martin, if you're able to pick up from here, but I'm pretty sure that you might need to reboot or something like that, because I don't know what is happening. Martin, is it okay? Can you hear that as well?
No, it's also got the breakdown. So I'm happy to take over. Just let me know that you're back on stream with your other internet.
Great. And you know what? Yeah, let's take Justin's webcam down as well. That might help. Great, Martin. Over to you.
Perfect. So what Justin was just going to take you through, Alec, is really, the difference between inpatient and outpatient. And I've got a personal story I can tell you about in the US to start off, which is my son had a sore arm, and we, being the naive new immigrant the last couple of years, sent him to the hospital to go and have an x-ray. I got a bill for $2,500. If you'd gone to a medical office building and had the same x-ray done there, you would have been in for probably $600–700 with the various treatments. So there's an enormous move in the US from the hospital systems and inpatient to outpatient. You'll see that the data over here, when our annual report comes out, will have the updated graph showing that the trend has improved further over the last couple of years. And it really is a trend also, as Justin was going to explain, that with technology, and that's the medical disruption. Technology is enabling most of these procedures to happen in outpatient buildings and in medical office buildings, where you literally go in, you'll have something done on your knee, you'll wait till after lunch, and you'll leave. So the need for people to go to these big hospitals, which are expensive and aren't exactly very welcoming, certainly is waning. And so hospitals are going back to what they really are meant to be, which is where you go for big procedures.
Mm-hmm. Justin, shall we give your internet another try? And what I'm going to suggest is we actually switch off your video, and let's just see if you can. There we go. If you can just keep talking us through, Justin.
Great. Yeah, now I've changed service providers, so I think that should be better, Alec. Yeah. So thanks, Mart, for covering there, and apologies, everybody. I hope that this is clearer, Alec.
Yes, it sounds okay now.
Great. So, we talk about these 5 disruptors, and I'm just going to cover them quickly, and some of them you'll absolutely understand. And I'm going to leave out the top one, consolidators, because this talks a lot to our new property in Jacksonville. And let's start off with the tech invaders. I think what is really fascinating is that the Tango, Facebook, Amazon, Microsoft, Google, and Apple have invested over $3 trillion in their medical advancements and their move into the medical space. And that is, without getting into a lot of detail, let's think about when you last had an illness of sorts. What's the first place you went to try and discover what was going on? It was most likely Google. And so I think we've got to take into consideration the effect of these tech invaders, as we call them, that are going to certainly be at the forefront of the change in what's happening in technology. From our own point of view, what we identified very early on was that a general medical doctor, your family practitioner that you go to, who charges a fee every time you go and visit him, would probably be threatened by one of the big tech invaders, and that is telemedicine. And telemedicine's been around and advancing very, very, very fast in the States. And we certainly were concerned about the development of this telemedicine. And I'll show you what actually happened over COVID, because the insurance companies effectively agreed to pay for telemedicine. So you didn't have to visit the doctor's rooms to be able to charge your patient a fee. You could effectively speak to them over the phone or over Zoom or Skype or some sort of video conference. So I think that's very interesting. The next thing is the vertical integrators. We looked at that first graph, and you understand that the hospitals are not getting the throughput of patients that they were in the past. So I guess the question you've got to ask is, what do they do about it? And the natural thing is they've got large balance sheets. They can go and buy the doctor's practices and the feeders that effectively bring patients into the ecosystem. So that's absolutely happening. Then there's the health retailers, and Martin would probably chip in here. You've got the likes of Walmart that are now putting practices inside their own operations. And I think if you look closer to home, you can see the Discams and the Clicks taking an active role in that as well, in the South African environment. So that's the retailing space. And then, of course, you've got the independents, and that is, if you want to go and have plastic surgery, you generally choose the plastic surgeon that's best for you. You don't just go to the hospital and get the one that the hospital provides for you. So these independent practitioners that generally at the top of their game, they can go and put themselves wherever they like. Patients will come to them, and so that's the independent. But let's move back to the consolidators, Alec, quickly. And I think that if you take family practice, and that's probably the most exposure we have to a doctor in South Africa, and I guess anywhere in the world. You used to pay to go and visit the doctor, you pay your fee, and of course, ultimately the medical aid, when the US medical insurance gets to pay that fee. And that is changing. And the new trend is towards a pay per outcome. In other words, the insurance company is saying, a patient is coming with a particular illness, I will pay you a set fee for resolving that illness. And if it takes 5 visits, 3 visits, if it costs you a lot of money in medicine or less, that's your problem. You take that risk. So it's a risk-based type of environment. Now, your small family GP can't do that. Obviously, it lends itself open for big multinational practices to come and buy up the general practitioners, put them all together, provide them with AI, data, and telemedicine that they can operate out of their same premises, for example. And so this is actually leads us into the conversation about what's happening in the US and this building that we're bringing in Jacksonville right now. But anyway, I thought that was super interesting, and certainly it went down well at the conference, Alec. Perhaps we could just jump to the next slide. So this is the effect of telehealth, which we believe to be an enormous threat. So how telehealth works, and I myself have done this in the US, you literally go online, you book an appointment, you speak to your family doctor face-to-face on screen, you get a diagnosis, they send you to your local pharmacy because they already know where that is, and you go, and by the time you've got there, the drug is waiting for you, and you've had your consultation, and you pay your $40 instead of $80 for the consultation. So, we think that it's a much easier, smoother process. However, most people, if you look at this graph, ultimately want to go and have a face-to-face meeting with their general practitioner, the one that they go to all the time in their local neighborhood. And you can see over COVID jumped to nearly half of all consultations were online, and now it's back down to 15, and I see it's kind of flattened out between 15 and 90. So that's really interesting. So I think we're less worried about telehealth now. We believe that certainly people do want that personal bond with their doctor. That's it, Alec.
Interesting point there, Justin. And just to remind everybody that this is interactive. There is a little question mark. If you click on that on your control panel and just type in your question, and I'll pose the questions to Martin and to Justin. Martin, do you take over now? Is that why you switched your camera on?
Well, I just also wanted to mention a few things about telehealth and some of the disruption that's happening in the US. So one of the most interesting aspects was when telehealth became a very big thing. We were receiving, newsletters and articles from all the various providers in the US saying, go online, go onto telehealth. You don't need to go to your doctor anymore. But what's become very apparent with telehealth around the world is there's only certain things you can do. A person can tell you how they're feeling, but in terms of taking various kind of assessments on the patient, you actually need to go see your doctor. And as Justin said, besides a cold and various things like that, or maybe, there's something wrong with you that the doctor can easily determine, you have to go in and have your various tests, x-rays, etc. And so telehealth has its place, but the most significant thing that's happened is that you would expect that the providers would say that we will only pay you a limited amount per patient visit. What happened during COVID is there was a major exception that allowed doctors to charge the normalized price for telemedicine, which means, number one, their practices have become way more efficient. Instead of me saying, I'm not feeling that well, I'm not going to go to the doctor, I can now book an appointment either before work, during, or after work, and still get online and see my doctor. So what's happened is the number of visits have actually increased, And it's all about moving towards data and knowing how to treat people. And that really is a huge thing as we move into the discussion about certainly the acquisition that we're talking about.
It's such an interesting graph, that it reflects so many other examples of what happened during COVID. Immediately there was a move, everyone went home, for instance, and the deliveries went through the roof, but then settled back at a level higher than it was previously, but not anywhere near where it was at the worst of the lockdowns. And that's quite well reflected here. So thanks, guys, for sharing that graph with us.
And Alec, the other thing I just wanted to talk about while we're on this is often talk about the impact of COVID, and it's a question that we get asked a lot, as you know, how we performed. So the one thing Justin and I wanted to touch on was in terms of COVID, there were two aspects. Number one was how our various tenants performed during the COVID pandemic. And then obviously there is the impact of COVID long term. And maybe Justin, you can just give an update on the COVID scenario so far.
Yeah, we had, we were very proud of our performance in 2020, Alec, as you recall, and there is a little bit of a hangover on 2021. I think one of the issues is delay in getting the new tenants into our buildings. So that's certainly something that we are coming across now as a new issue. But if you just look at, overall the effect of these medical office buildings, and I'm circling back to the conversation that there is this trend towards doctors setting up practices within their own offices, being able to do surgeries with having a little surgery center attached to their rooms, etc., etc. And this is the net trend of the demand for these medical office buildings. I think this is fantastic data from Revista. Since 2008, the GFC in 2008, where there was obviously a little bit of a bump, it has just continued all the way through. And I think we have sort of the Q2 and Q3 on the 2020 side, and you can see that through COVID it just flattened out. It had no real drastic effect. And this is, by the way, your rent per square foot, net operating income per square foot. So I think that it's quite a fascinating a graph to look at, to see the consistent growth and effect, the little impact that COVID had on NOI.
Well, I think Justin, if I could just jump in there and just mention that, as I said, that talks perfectly to what happened last year in terms of the profitability of most of the medical practitioners, certainly from Q3 onwards, bounced back quite significantly. And we as OrbVest experienced a scenario whereby existing tenants continue to pay well. What Justin was talking about in terms of the hangover was the installation of new tenants. And so obviously, if you look at various buildings, whether it's Medical 26, or if you look at some of our other buildings where we were bringing new tenants into the building, we've had obviously delays that are going into 2021. But that's the reason why also, OrbVest is on top of the situation in the US. We're monitoring it. If you take, for example, Medical 25, of the whole building, we've literally got 4 more people to install in the building, and then we've done and dusted. We got a fully tenanted building. But that's really the real impact that I think a lot of people are going to see going forward. It's either in our space, you've got delays with new tenants coming in, and for example, in multifamily and other asset classes, you've got delays getting non-payers out. So I think each of those niches are going to play out in the next 6-9 months. But the good news in the US is that the fundamentals are still very stable, and that tenants generally pay in each of these niches. And so I think that you'll see a strong rebound in the US in the coming couple of months as more and more people are vaccinated. As you know now, Alec, it's up to nearly 3 million people a day.
Incredible. There's a question from Manu before we leave telehealth. He says, on the impact of telemedicine, I'm not so sure that it is stabilized. Yes, we can see the panic spike March to April 2020, but virtual medical practice will more likely grow and take a larger share of the health market in future. And I guess that's a comment rather than a question, but the question that obviously flows from that is, what kind of level do you guys work it into your projections? If we're sitting at 20% at the moment, in fact, let me just move that graph back there, 19%. where do you think this is going to finally stabilize? Is it likely to be a slow increase from here?
I think that our concern, Alec, was that this would be more of an organic growth that would happen as more people trust the system and get to use it. And I think what you've seen is that lots of people adopted it, and now they're moving back to the traditional ways. And let's face it, there's still people are nervous about going to the doctor's rooms because of COVID, but still, this people have migrated back to the room. So I think, Manu, just to answer your question, I think that it's definitely going to be more gradual than we anticipated. And I think, as Martin said earlier on, there are certain examinations that a doctor actually has to have his hands on your body. You've got to give the blood. You've got to, I guess, that maybe is certainly, helping us to understand it better. And I think Martin will talk a little bit later on about the building, because he learned a hell of a lot last week, actually, as a result of meeting this one of the doctors that sold on to Invacare. But I'll leave that for him to talk about a bit later on. Manu, I hope that clears up a little bit.
But Manu, I just wanted to jump in and just answer it. When telehealth first came out, and this is really one of the disruptions, is that we as OrbVest immediately pulled back to, there was no more than 5% of doctors or general practitioners in our buildings. And so we specifically stayed away from it. Now that we've understood it, and we're dealing with players like Grant Thornton, understanding the real big macro trends in the country, is that the doctors are not going to be wiped out by telemedicine. What's going to happen is, in fact, it's made them more efficient. So it's all about, can your tenant make enough money or the same amount of money that they can pay your rent? That's what it's all about. And so certainly the first question we go into any tenant is looking at their sustainability going forward, and particularly in this building. It was one of the very first questions we asked. What have you done regarding the disruption in the medical space? Because we need to understand that the person's going to be around for many years to come.
Very interesting conversation we're having there. But on a broader scale, Stephen wanted to know, presumably from you, Martin, he says President Biden's new healthcare policy and the free healthcare to immigrants, what is the thinking on this from the medical fraternity in the US?
I think it's fair to say that anything regarding healthcare and other subjects in that realm are very political in the US. There's not a single conversation you will go to dinner and try and avoid more than politics or healthcare, because there are strong views on the right and strong views on the left. But suffice to say this, I don't think the healthcare industry likes the concept of free healthcare for everyone, because what they're really trying to do is they're trying to cap the margins. What Henny, our partner, will tell you is that in every country in the world, it's almost impossible to try and get a reduction in healthcare costs. It's the same as trying to expect the banks in South Africa to reduce their profit over time. But what it does mean is the following, is that inadvertently in America, Obamacare, etc., have created these end-to-end systems where essentially there's consolidation, and instead of them making less money, they've just bought up a lot of players in between, and they've ended up making more money overall. So to answer the question directly, I think that they want to expand the coverage to everyone, which will cost the government a lot more money. It's good for the healthcare industry because of the fact that there will be more demand for healthcare. However, they are now trying to focus on getting the margins down, which is incredibly, incredibly complex and difficult. And as you know, in the US, nothing happens quickly. It takes years and years to implement, literally years to do anything here.
Costas's question is also related to this. He says, what about when there's sensors in the body, i.e. those are in virtual hands? Is that not a threat?
So those kind of technologies absolutely are also going to play a role. But remember, what we are also talking about is, remember, the doctor's practices are only one component of healthcare. You've still got everything else like pediatrics and imaging and various cancer treatments and rehabilitation. There are so many sectors in healthcare. Remember, if you think about even your own personal world, you may go to the doctor once, but remember, the doctor is the gatekeeper. The moment anything's detected in America, you are then sent off to various other niches. What's very interesting is in South Africa compared to the US, it works completely differently. In South Africa, if you want to go to a specialist, you book an appointment with a specialist. In the US, you always have to go to your doctor. It's the most frustrating thing. And as a South African, you know, coming from South Africa, you know, when I want to go see someone, I have to first go to the doctor. He's got to look at me, he's got to check me out, he's got to ask all the questions, and then he refers me. And so that's the way it works in the US, which does seem a bit archaic. So the sensors, etc., will certainly help a lot of these scenarios. But remember, in a lot of these scenarios, it's also very expensive. And in fact, there's a view that these will just simply make it a more efficient process, as opposed to certainly detracting from it. I hope that answers the question.
I know we want to get on to the new project, but there's a goodie here from Jason who says, is there a specific reason why these investments are only in the United States? Why not the likes of China and or Europe?
Yeah, so I like to take that question. You know, in business, I believe the one way to scale a business is you've got to have absolute clarity on what you do and where you do it, and you've got to nail it. And so we have always felt that for most investors around the world, you want to actually put your money into a very safe, stable area where you know you're going to receive consistent dividends. That's our business model. I'm not saying there's anything wrong with Europe or Latin America or other places in the world. We just felt that when we looked at the entire world, and we've had experience, most of the executives in investing somewhere, is that in the UK, your cash on cash is low, and then maybe you're banking on the upside on your yield. The same as in Australia and other places. And we just felt that one of the biggest markets in the world was the United States. And in terms of the United States, we just chose that as our hyper focus. It's all we do. We buy buildings in the United States. It's a $1 trillion market. There's enough for everybody to go around. And so we believe that the model works well, where we can take people's money from around the world, invest it only into the United States, become experts at it, and get the dividends and the money back to people. And that requires a lot of experience and knowledge.
A final question before we move on here is from Mbayazwe, who wants to know, what did the number of telehealth consultations peak at in March, April, and what was the level in November 2020? Just to get I suppose in numbers of hundreds of thousands, or millions even. Do you have those numbers, Justin?
Fred, don't have them on my fingertips, but perhaps if you'd like to reach out to me, we can just look up from on Revista and give them the correct data. Very happy to give them that information.
Brilliant. The questions are coming in, so I think if we're going to get onto the new project, we better get moving.
Great, yeah. I think if you just move on to the next slides there, Alec, I think there's only 1 or 2 points of interest. I think this, again, kind of relates to one of the questions from maybe Costas. I think the geographic area is also a focus of ours. You know, we're very analytical. We look at the data, and we look at states that, first of all, are growing, where there's a growing population, a growing GDP, and where there are landlord-friendly rules and regulations. You know, we have experienced situations with the building where we've got really abnormally high rates and taxes on the building, and that, of course, you know, can certainly cripple your investment. So this is really the states that we invest in, and you'll see that we did those 2 at the end of last year in Arizona. So we've managed to open up Arizona, and now finally today we're going to talk a little bit about Florida. Certainly one of the states we've been trying to get into for a long time, and we've at last found the right partners and the right in there. But let's have a quick look at the last 2 points that I just want to make, Alec, on the overall market and why we do this medical office building a focus. If you can just move it forward.
I just wanted to ask you before you go there, the population growth, it's very interesting. So you've targeted those states which are growing, where the populations are growing more rapidly.
Yes, I think the first thing is you've got to get in front of the wave, to use a surfing analogy. If you have a growing population, plus you have a growing aging population, plus you have growing GDP, you know what, you can afford to make some mistakes, and in 10 years' time, the chances are your building is going to be worth more than it's worth at the moment. So I think that's really it, Alec. Excellent.
Okay.
So I think you know, getting into the jacaranda and the the property that we're about to promote shortly, or talk about shortly to you guys, is this, Alec, that I put up at the conference. Also, it was great. It gave people a lot of understanding as to what our offering really is all about. And I think on the left-hand side, you can see that at a relatively low risk and volatility, but also low return, would be a fixed income product. And on the other extreme would be equities, where there is volatility, there is some risk, but the returns are significantly better. The black dot at the top is where, for example, a property developer would sit. Obviously, very opportunistic. Certainly, lots of profits to be made. But the more that you get into the risk of doing a development, the more chances you've got of either getting rich or poor very quickly. And so we don't go anywhere near that. Where we focus is in the three segments in the middle, in the yellow, which is core, core plus, and value add. This building we're going to talk about today is value add. Why? Because it's not just a fixed income building. It is a building with some vacancy, which means if we can fill the vacancy, it adds an enormous amount of value to the building, and you end up with a great return at the end of the period, which is what we call an RR effectively. And this also kind of went down well, Alec. I know I keep referring back to the conference, but I think people get to understand these sort of offerings in the US. And maybe Martin, you love to talk about this, so I'm going to let you come in on this one.
So when it comes to the returns, everyone knows that we target really between 7 to 8% cash on cash, and we target double-digit returns when we sell the building. And even those returns over time, you may have 1 or 2 quarters where there's a disruption of a dividend, where things happen. But the reason why hopefully people invest with us is because over a 5-year period, they've seen the consistent returns. It's amazing to think that the team has now been acquiring buildings in America going on now 7 years. It's a long time, and it continues to grow the story. And you can see our returns over here versus the market. And specifically, we are receiving a tremendous amount of interest at the moment from other countries in the world, because they're just very concerned about the equities market. There are a lot of people that are saying it's going to rebound and go up a lot further. There are a lot of people that are saying that perhaps it's time for a pullback. But the one thing with real estate is that if your tenants are consistently paying over time and your fundamentals are sound, where you've bought the building and your rental income's coming in, you should consistently get your returns. And remember, this excludes the capital gain at the end. So when we sell at the end, you can generally add about 3 to 4% onto these numbers, which gives you your total returns over time of anywhere from 11 to 16, 17% per annum in dollars.
Exactly, and the next slide will show you that. So I think these are 3 exits. Medical 1, this is a portfolio of buildings 1 and 2. Altogether, I think there's 8 buildings in this on these 3 exits. And all of them well in excess of in the double digits. So you take that double-digit return in US dollars, and apart from equities, I think there's not much that can touch that. And Martin?
Exactly, and Medical 5 is a good example. We were approached in November last year by one of the REITs. They owned the building next to us. They said to us, listen, we want to buy your building. We said, sorry, it's not for sale. They said, well, we really want it. We'll pay you your asking price. The price that we finally negotiated on was exactly as per the original brochure. It was that people had received, I think, close to 8% cash on cash and total returns of 11.3 over the 5-year period in dollars. And that's what they received. We finalized it in February and paid everyone out in March. And so that's what a typical building and a medical office building should perform at in the United States, in our segment that we play in, or what we look for.
Thanks, Alec. Yeah, I think Martin has taken over this part because he spent a week down in Florida last week hanging around the building, sending us lots of pictures of what the floor looks like, etc. So he's got absolutely first-hand info, Alec, so he's going to take over here.
For the last 2-3 years, we've really been trying to get into Florida. The challenge in Florida is a lot of the buildings are single-story. They're small little itty-bitty buildings, and they got relatively small tenants in them. And we wanted something a little bit meaty. So the starting point is, why this building and how did we get it? So you know that our model is very often we partner with really significant players in America. And what we do is we expand with them and we grow with them. And so one of the partners that we've had a relationship going on now 1.5 years is Lincoln Harris. Lincoln Harris is one of the largest players in the medical office space in the United States, part of the Lincoln Group. And what they do is a number of different aspects in the medical space, but particularly one of their divisions, the Lincoln Harris Property Group, actually manages over 700 medical office buildings on behalf of the large players in the REITs. And so when we approached them and we started to come together, it was about finding buildings and doing them together as partners. And so it's taken a long time. They're a very conservative group. Certainly during COVID, they wanted to rather take a step back and manage their buildings, because obviously there were a lot of their building owners that were very concerned how they would perform. As we've seen now, they performed unbelievably well. And so this opportunity arose because Lincoln Harris basically is the manager of the building, and Lincoln Harris essentially operates in 22 states, and through their relationship, they got to understand the history of this building. The history of this building is that it is based in Jacksonville, Florida. What people don't understand is Jacksonville, Florida is one of the largest cities in the United States. It has a population that I now think is over 1 million people. It is receiving enormous migration inflows, and it's extremely well located. And what actually happened was that a previous company had owned the building. They were not focused on medical healthcare at all. They were very stubborn when it came to leasing up the building and what they were prepared to spend on it. And there was a deal whereby the doctor, together with his previous owner, ended up in a situation where they wanted to sell out, because the doctor was selling out in his practice to a very large player. And so the opportunity came about that, given the end of their holding time and the circumstances I've described, Lincoln Harris heard about it, and off market, we managed to do the deal. We've been chasing this deal for nearly 6 months. It's an entry into Florida, which means we are now going from 4 states to 5 states. And as I said, it's not very easy to find the right deals in Florida. So it was through our relationships and our network that we got this off market. I'll go into some of the detail later in the slides, but suffice to say that it's a 76,000 square foot building. It's a very large building. It's got some really solid tenants, and I think we'll go through the numbers one by one in the following slides, Alec. Here's a picture of the building, which is known as Fleming, and there are actually 2 buildings that almost create an L. And in the main building is, you can see the primary individuals and tenants, who are the family care partners. And I'll just start off and talk a little bit about family care partners. Family care partners is a doctor's practice that has been serving the Jacksonville community for literally going on decades. I spent time with Dr. Career. He's an amazing individual. He's well known in Jacksonville, and he has really evolved into a one-stop shop for many of the people in Jacksonville, where he does pediatrics and various other things and procedures and imaging, etc., in his buildings, and physiotherapy. And so some of the tenants you can see are orthopedics. You can certainly see on the right-hand side, you'll see a picture of one of the tenants in the building next door, which is DaVita. DaVita is listed on the New York Stock Exchange. They do dialysis. They're well known in America, and they have got many outlets and are very, very solid. So that really just gives you a high-level overview of the building and some of the tenants. If we can move on to the next slide. Again, some of the tenants. So what you can see in this slide is the fact that you've got the 4 key tenants that underpin the building. I think what's important to note is that family care practitioners is at the moment in final discussions to actually sell the entire practice into almost a joint venture with Innovacare. Innovacare is a management company that manages doctors' practices and services across America. It'll create one of the largest groups in America. They are very, very powerful. I think they do something like $3 billion turnover per annum. And so this deal itself has been going on for nearly 6-7 months, and really does create a very powerful tenant. The space available, I just want to talk about that. What's very exciting is that the vacancy over the last 6 to 9 months, there were a number of tenants that came to the building and wanted to actually move into the building. And the previous tenant, we had a long discussion about this, the frustration with the doctor, where he said, I brought tenants to the building. They wanted 80 per square tenant installation allowance, which is what we need in medical. And the previous owner said, we pay 40. And there was no negotiation. And so they let the tenants potentially just walk away. And so Lincoln Harris, through their frustration as a property manager, when the building came about, said, ourselves together with the doctor and the right tenant installation allowance, we're very comfortable that we'll fill the space. And we've got the guys who previously came to us who are still potentially interested in coming back because the building is beautifully located. And so that is the great opportunity. The doctor himself is coming into the building and he's putting close to nearly $1 million in the building with us as a partner. So he's putting his money where his mouth is. Our partner, Lincoln Harris, is putting their money where their mouth is, and so is OrbVest. So you've got 3 players coming in who we believe we can certainly have a lot of success leasing it up. It's not built into the price, which means obviously then when you lease it up, you get a lot of capital gain and growth and value creation. And so it really is a very unique opportunity to find a good building in a good location with upside underpinned by 3 reasonable parties that I think can do the job. On to the next slide, Alec. This just shows you the growth in terms of, the various rentals and the per square that is being paid, moving from around the 18 up to the 20 mark, and the consistent growth over time in Jacksonville. What was interesting was when we were in the area and we were talking to the doctor and we were talking to the various brokers, they were saying that pretty much within a 20-30 mile area of this building, there's not really many facilities available at this stage to be able to accommodate players wanting to come into the space. And that's another reason why they were quite excited about being able to lease up. In terms of the lease up, the way that we as OrbVest have tried to do it on this building, together with Lincoln Harris and the doctor, and the way that we've learned from the other building is we've learned that things can happen in the world that may cause leasing delays, as we've spoken about. And so instead of saying we'll lease it up in year 1 or year 2, we sat down and we said, let's make a conservative assumption about a very small percentage in year 1, then in year 2, then in year 3. Naturally, we want to bring tenants in sooner, but I think that in terms of being able to create sustainability of dividends and performance, we've really pushed this out in a very conservative manner, which you'll see in the numbers I'll get to just now. Next slide. So over here, you can see that the building we're acquiring for approximately $14.4 million. You'll see that as we get to the middle of that area, you'll see tenant installation reserve, year 1, year 2, year 3. It is the space times by essentially 80 per square. That is what the banks provide in their loan documents. It's called a facility where you draw down as you have tenants coming in and you produce a lease for them. That takes our total acquisition cost to around $17 million, which is made up of $7 million of equity and $10 million of debt, which we then obviously obtain in the United States. And you can see basically how it's broken down. What's very interesting is that out of the $7 million, and I just want to assure everyone on this call that Justin's had quite a tough time, because if you take the doctor's $1 million and you take the fact that we've already had people approach us and say, the very first building in Florida, we're in straight away, bank it. And so we've pretty much already closed out the corporate investor contribution. And as Justin has had to split this up around the world to all of our partners, this building, we are quite comfortable, as we've seen in the other couple of buildings, will be gone within, I would say, 2 to 3 weeks. And we're very comfortable we will oversubscribe. Justin, you want to jump in here because you're the one who's got the challenge.
Yes, I know Alec does get concerned when we sound like we're selling it up, but Alec, if I could say that if we've got investors online at the moment, please guys move fast. It's very uncomfortable for us to say no, and this project is already absolutely firing. We launched it early on in the week, actually the end of last week, and already it's it's mostly done. Why I say mostly done? We have to be a little bit vague, Alec, because people obviously make commitments and then we need to wait till their money lands, and sometimes money is bouncing around the world, and so we're not sure whether it lands or not, and that we only clarify next week. But certainly demand is going to overshoot supply in this case very quickly.
You also have a record of that kind of situation. If I remember from the last project, that was also sold out very quickly.
Absolutely, yeah. The second building in Princeton was wrapped up, and again clarified and wrapped up within 2 weeks, but we were oversubscribed within a week.
Wow. Okay, so there's not it's not a sales pitch. It is the reality. If you want to get a slice of this, you're going to have to get your act together.
Yeah. Alec, if we can just move to the next slide. And so the returns over here you can see are denoted in terms of if you had to invest, for example, $10,000, you would be earning, call it 6.1 in the first year. That's because we're now starting to lease up, and then it moves towards 8 and then up towards 9%. And it shows pretty much what we foresee as the projections going forward. Those are your cash dividends that you earn per year, which is paid out quarterly. And remember, OrbVest only acquires buildings that are income producing on day one. We will not go and buy a building unless it has solid tenants, it's producing an income on day one, and there is a story around it. Yes, as you've heard, there are sometimes delays, it's for a quarter or two, but generally these are the numbers. What we also have tried to do on this particular building is, as I said, push out the assumptions for a year or two, just because of the hangover of COVID, that it may take longer than potentially we thought. What does show towards the bottom is that the building should generate a 14% or 14.7% IRR, which is your total return. And for our investors who go via our international channel at the very bottom, there is obviously a impact of pre-tax and post-tax, and that obviously then leaves you with a net return of 13%, which then gets returned to you as your dividend, and you would then disclose it in your various personal returns. So this just gives you a feel of how we expect the building to perform going forward.
Martin, we got quite a few questions.
I'll hand over to Justin.
Yeah, Martin, we got quite a few questions that I'm sure are going to need answering, and only about 12 minutes left. So I don't know how you'd like to handle it for the rest of the presentation.
Yeah, I just want to cover, Alec, quickly. Unfortunately, we have to get some compliance stuff out the way, and I just need to let investors know, please, guys, we are a regulated financial services provider in South Africa. If you're in South Africa, and you just need to note that we're not here giving financial advice. We are certainly putting up numbers that are forward-looking. Understand that RR and projections are all forward-looking. We obviously do our best, and we have a track record, and we hope that those numbers will be achieved. But please, it's very important, Alec, that people do understand that they should go to their financial advisor and they should get advice before making any investment. And I'm not just talking about this. Just to mitigate quickly, there are a couple of points here. If I can move straight into the slide in the interest of time. Evaluation risk. This is the big one on the right-hand side. Market conditions can influence the timing of the exit. Well, there are a couple of things that we always do. Remember, our gearing, in other words, our loan to value is always capped, and we do not go over 65%. In this case, it's closer to 60. Debt coverage ratio averages above 3 times the net operating income, which means that your annual income can cover the cost of debt by 3 times, which is very, very strong, and certainly gives you a very big cushion in the event that your income is disrupted. And the fact that we have got a very strong bank who is underwriting this deal. Lease up risk. There is a vacant space, and let's be absolutely clear on it. There is a chance that we won't be able to lease up that space, but remember that this partner of ours, Lincoln Harris, looks after nearly 800 medical buildings across America, and they've put their own money into this deal, and they've signed for the debt. They would not be doing it. They're a conservative operation if they did not know that they had a very good probability of putting a tenant in there, and I think that's why they're so keen on this deal. Tenants can default. I think the probability of tenants defaulting on this particular project is very low, and the reason is that, as Martin mentioned, Inbocare are taking over the doctor's practice, or we assumed that by today it would have been signed. We're told that it's just a matter of getting signatures on paper, but they will provide a guarantee for 10 years on the lease. And that means that the majority of the building is absolutely covered, which is really, really good to know. And then finally, interest rate risk. There is very high probability that interest rates will move upwards in the US. We will lock this interest rate down for the period of the investment. And then finally, just to cap off on this particular investment, if you go to the next slide there, Alec, in summary, again, main tenant has been bought out, was in the process of being bought out by Inbocare, and there's a 10-year guarantee. Lincoln Harrison's managers there at 730 medical office buildings in 22 states across America. These are the guys that Martin was hanging out with last week, and we're certainly hoping to open up a whole line of buildings that they can introduce us to through their network. Obviously, it's a great building, high quality building, very little maintenance needed. It's a new building. It's a large building, and the pricing of $188 per square foot is below replacement cost, which is very important to the fundamentals of any argument of buying a building. Can somebody knock down the building across the road and build one for the same price? Absolutely not. Very new building, as I say, 10 years old. WALT, which is the weighted average lease term, is 9.2 years, which is fantastic considering that your investment is for 5 years. And then that vacancy, that big plate of vacancy, as Martin mentioned, we didn't pay for it. So effectively, if we manage to tenant it up, we get a considerable bump in our IRR at the end of the period. And then finally, Jacksonville is absolutely cooking at the moment. Speak to anybody in Florida, and they'll be able to tell you that. So that's it all from me, Alec. Let's move to some of those questions.
Indeed. Denise wants to know, in your properties, do you have robotic pharmacies, and how big are these in the niche market space in the US and other parts of the world?
So robotic pharmacies are a new thing. No, we don't. I know that I saw that robotic pharmacies are coming from the article at the V&A waterfront. No, the large players like Walgreens and CVS are looking at it, but no, we don't at this point right now.
Sean wants to know, what about the potential for hyperinflation? How will that impact you?
So a good thing is hyperinflation is really going to impact two scenarios. Number one, your tenants and your fundamentals will mean that their revenue will go up. How do we mitigate it? We mitigate it by the fact that every single building we cap our interest rates. So we don't allow ourselves to be exposed to any kind of interest rate hike.
And Dele wants to know, can you explain the difference between cash on cash and IRR and their correlation?
Yes, so cash on cash is an amount you earn per year. And then what is done in financial services is there's a term called an IRR. It's your internal rate of return. It measures over a period of time all different investments. If you had to get different amounts at different stages, what is that total number getting to your total return on a similar basis? And so when you take your cash on cash every year and you add the capital gain to it, that over the 5-year period gives you the IRR we talk about, which is over 10% in dollars. In fact, in this building, it's 13% per annum on average in dollars.
Rion wants to know, what would the impact be of higher interest rates? I think you've said that you cap your interest rates, but if there were to be higher interest rates, would that have any impact on this or other buildings?
It may have an impact on new buildings going forward where we've got to acquire them. I physically had a meeting and I had dinner with the banker who happens to be financing this building, a very large group that only focuses on healthcare in the United States. And one of the first things we said is that we cap the interest rate and the exposure on every single building we acquire. And he said, well, good, because that's what we like all our various customers to do at the moment, because they have the same concerns.
Brendan wants to know, what is the entry-level investment amount, and can you pay from a Seychelles account directly into OrbVest via a notary of course, I think it says.
Justin?
Okay, not sure I got the end of the question, Alec, but absolutely, the minimum investment is $5,000, Sean. Remember that what you're effectively investing in, if you're an international investor, and the most popular way of investing is via our listed Seychelles merge company. So effectively, you're investing in a listed security in the Seychelles. So to move your money into the Seychelles from the Seychelles, absolutely no problem. You always have a broker dealer. Our broker dealer we use is PKF Capital, part of the global franchise, and they actually handle the money almost from end to end.
Bruce wants to know if you could just recap on that. What is the cash-on-cash return and the IRR? What are those numbers?
So the average cash-on-cash is sitting at around 8% over the project, and the IRR is going to be sitting at 13% through our normal traditional structure. So you can see that it is certainly within our sweet spot. And in fact, I think this building offers potentially a lot more upside if we get the leasing right.
And he has a follow-up question which says, how long are the leases?
The leases in America and healthcare is what makes our proposition so compelling. Is I say to people, in industrial, you'll normally sign leases of 3 years and commercial to 5 years. In healthcare, generally, you'll sign between 5 and 10-year leases. You also put in a lot more tenant installation allowance, because remember, a healthcare practitioner coming into a building doesn't want to be there for 5 years and move to another building. He needs his customer and he wants to be in that area. So he's happy to commit for a longer lease, but then his first question is, well, are you going to give me more money to make my premises, according to my specifications for 10 years? So the leases are longer. We would hope to sign leases of between 5 and 10 years of new tenants coming in. If they are really strong players, and Lincoln Harris finds us credible long-term players, they will even sign leases up to 15 years.
Brendan would like to know, where are the payouts made? Where they paid to? Can they be paid to any account globally?
Just you take it.
Yeah, absolutely. They can. So your money ends up in a trading account in the Seychelles at the exchange, and you can draw out that money to your nominated account. I think the only thing that's very important is KYC, as you understand globally, is becoming incredibly tough. So if you want to change your bank account, you have to obviously go through the KYC process again. So if you can prove your domicile and that you're a tax resident of that particular country where your bank account is, then you can obviously repatriate to that bank account.
Jeff wants to know, what effect would rising bond rate yields have on your forecast capitalization rates?
So I think the speculation around bond yields and interest rates all fits together. I think the fact that when you potentially have increase in any kind of inflationary aspect, you're going to have a shift in money potentially to different sectors. I think what we have seen already in the first quarter of this year is there's been concerns around hyperinflation or inflation around the world. And all I can tell you now is the medical office building space is becoming a lot more competitive. There are a lot more players moving in. When I speak to the large players in America, they're starting to all want to talk to me about doing partnerships, etc. They want to get their money into the space. They see it as a long-term, stable play. And so that's certainly my perspective. How this will play out long-term and what the final impact will be, I don't think anybody really understands. Suffice to say one thing. The medical office building space, the cap rates, meaning what we buy it, has remained incredibly consistent. We've got other graphs and slides to show over the past 20 years through even the GFC. So that is the reason why we like to say, as we've said all along for many years, is that if and when a correction or recession arrives, you'll hopefully want to be in healthcare.
And the final question, we've almost perfectly timed today's webinar, comes from Andile. And it's a double-barreled question. What's the minimum investment? I think you've covered that again, but it's worth repeating. And when is the closing date?
Good question, Zandile. $5,000, absolutely. Your second investment, by the way, goes down to anything you like down to $1, basically. So once you're in, you're in. And then the second question is closing date. So what happens is we have made the offer, and people subscribe for the offer. And as soon as we fully subscribed, then basically that's the investment over. As far as closing is concerned, we have a tight closing of 60 days from when we signed the PSA, which is probably running another 50 days from now. That is when we will have to pay and acquire the building, which we will do. And then we will then list it on the exchange probably 30 days after that. That's how the timing works. But in this case, tight closing date, 60 days, 10 days have already gone, 50 days from now.
Martin, Justin, final words?
So from my side, Alec, I just want to thank you again for hosting this webinar. We've certainly gone on a great journey. And I remember saying that one of our goals for 2020 was to get into the state of Arizona, and we achieved that. I said that we wanted to get into Florida by the end of 2021. I myself did not expect to be in so quickly. This opportunity came about sooner than expected, even though we've negotiated a long time. And so I'm delighted to bring this to everyone. And really, it's just an evolution of the story. And I'm excited to be able to offer this to clients specifically in South Africa. Just a reminder that it's not only South Africans, it's clients around the world that we have. So hence when Justin says move reasonably quickly, we don't like to let people down.
Justin?
Nothing much to add to that, Alec, apart from just to thank you for hosting us once again, and of course your audience for giving up their lunchtime.
Well, that is the webinar for today. Well done, guys. You actually were 1 minute within the 1 hour, so perfect timing there. You're not breaking into anybody's lunchtime. I'm sure that they kind of postponed that until 1 o'clock today, Justin. But anyway, good to be talking to you again here in South Africa, and Martin, of course, in New York. And the first time that you've gone into Florida, well, it'll be interesting to see whether that demand that you've been experiencing so far still keeps the opportunity open for long enough for the BizNews community to come along and participate. Thanks again, and look forward to the next time. From me, Alec Hogg, cheerio. Thank you for joining us for this webinar, which is compiled and produced by the team at biznews.com. A recording of this webinar will be available later today on the biznews.com channel on YouTube. From our team, until the next time, cheerio.
Well, she ran away.